If you opened your portfolio this morning, Wednesday, January 21st, 2026, and felt that specific kind of nausea that only a crypto investor knows, you are definitely not alone.
Yeah.
It is ugly out there. We're talking a sea of red. Bitcoin broke that $90,000 level everyone was watching. And it didn't just break, it smashed right through it down to the 87,000s.
It's a bloodbath. There's really no way to sugarcoat the price action itself.
No.
It is one of those days where you just, want to close the laptop and go for a very long walk.
Exactly. And honestly, I'm trying to wrap my head around it because the headlines are all over the place. I'm seeing stuff about Japan. I'm seeing trade wars in Europe. It feels like we're watching a heavyweight boxing match where Bitcoin is just getting punched from every angle.
That's actually a great analogy. It is a fight, but the combatants aren't who you think they are.
Okay.
In one corner, you have absolute global macro chaos, what analysts are calling the Takaichi Shock out of Japan, alongside a bizarre geopolitical standoff over Greenland. That is what is forcing prices down.
Okay, stop right there. The Takaichi Shock. I saw that trending, but I assumed it was some niche political drama. How does a Japanese election result tank my Bitcoin portfolio in New York?
That is the big question. And in the other corner, fighting against that crash, you have massive institutional entrenchment. While retail investors are, panic selling, the smart money is doing something very different.
So that's our mission today. We need to unpack this mess. I want to understand why a bond market in Tokyo is crushing crypto, why the EU is threatening a trade war, and why, in the middle of all this panic, MicroStrategy just decided to spend over $2 billion.
It's a crisis briefing, essentially. The price is down, but the story under the surface is much more complex than just selling.
All right, let's start with the root cause. Because if I just look at crypto Twitter, everyone is blaming leverage or some exchange rumor, but you're saying this is an exogenous shock.
Completely. It's coming from outside the house. Specifically, it's coming from Tokyo.
Break this down for me. Who is Takaichi and what did she do?
So, Japan's Prime Minister, Sana Takaichi, made a move on Tuesday that really rattled global markets. She announced a snap election for February 8th.
Okay.
Now, elections create uncertainty, sure, but the real kicker, the thing that terrified the financial world, was her pledge to suspend consumption taxes on food.
Okay, playing devil's advocate here, suspending taxes sounds great for the average person buying groceries in Tokyo.
Yeah.
Why does the bond market hate that?
It sounds great for the voter, but it's a nightmare for the creditor. You have to remember, Japan has a debt-to-GDP ratio over 250%. I mean, they are swimming in debt.
Right.
When the leader of that country signals, hey, I'm going to cut our revenue source taxes while implicitly promising more populist spending, the people holding that debt panic, they look at the balance sheet and say, this isn't sustainable.
So they sell the bond.
They sell them aggressively. We saw a historic capitulation in Japanese government bonds, or JGBs. And when people sell bonds, the yields, the interest rates spike up.
How bad was the spike?
In the bond world, it was an explosion. The yield on the 40-year JGB breached 4.0% for the first time since 2007. It peaked at 4.215%.
Wow.
Traders were describing it as complete annihilation of the order book. Even the 30-year yield jumped nearly 30 basis points in a single session.
Okay, I get the Japanese bonds crashed, but I still need you to connect the dots for me. How do we get from a 40-year bond in Japan yielding 4% to Bitcoin dumping 5% in the U.S.? Is it just general fear?
It's mechanical. This is where we have to talk about the yen carry trade. This is the engine of global liquidity, and Takaichi just threw a wrench in the gears.
The famous widowmaker trade. Walk us through how this works, simply.
Think of it like this. For decades, interest rates in Japan were near zero. It was basically free money.
Right.
So big global hedge funds would borrow billions of Japanese yen for almost no cost. They take that borrowed yen, convert it to dollars, and go buy assets that actually yield a return like U.S. tech stocks, NVIDIA, and yes, Bitcoin.
So they're using a cheap credit card from Japan to buy high-risk assets in America.
Precisely. Bitcoin has acted as a massive liquidity sponge for this cheap yen. But when the Japanese bond yields spike like they did yesterday, two things happen immediately. First, the cost of borrowing that yen goes up. The free money isn't free anymore.
Right.
Second, and this is the killer, these big funds hold Japanese bonds as collateral. When the bond price crashes, they get margin called. The bank calls them up and says, you need to give us cash right now to cover your position.
And if they don't have the cash lying around?
They have to sell something, and they don't sell the stuff that takes 3 weeks to settle, like real estate. They sell the most liquid 204/7 asset they have. They sell their winners.
They sell Bitcoin.
Bitcoin becomes the ATM. They aren't selling because they hate Bitcoin. They are selling because they have to pay back their yen loans to avoid bankruptcy. It's a global liquidity drain. Dan Tapiero from 10T Holdings called this out immediately. He said the crypto wipeout was directly linked to this annihilation in Japan.
That makes so much more sense. It's not that the Bitcoin thesis failed. It's that Bitcoin is the easiest thing to sell when the house is on fire.
Exactly. Bitcoin is the only asset that never closes. So when trouble starts in Asia while New York is sleeping, Bitcoin takes the first hit.
So that's the pressure coming from the east. But looking at the briefing, we also have a massive storm brewing in the Atlantic. This Greenland situation. I honestly thought this was a joke when I first saw the headlines. A trade war over Greenland.
It sounds absurd, but the economic implications are deadly serious. This escalated very quickly. On January 20th, French President Macron gave a speech at Davos that really rattled the cage. He didn't just complain, he threatened to use the trade bazooka.
The trade bazooka, is that a technical term?
Effectively, yes. It's formally called the Anti-Coercion Instrument, or ACI. The EU adopted this back in 2023, but it's like a nuclear option. They've never really used it.
What does it do?
Usually trade disputes go to the World Trade Organization. It takes years. Lawyers argue in Geneva. The ACI allows the EU to bypass all of that. It gives them the power to instantly slap counter tariffs, ban imports, or block procurement from a country that is trying to coerce them. Macron explicitly threatened to use this against the U.S. in response to President Trump's tariff threats regarding the Greenland dispute.
So instead of a slow legal battle, we're talking about an immediate economic freeze between the U.S. and Europe.
Right. And the market hates uncertainty. This triggered what analysts are calling the Sell America trade. Investors started dumping U.S. assets because they fear a trade war will trigger a recession.
So the Dow Jones dropped 870 points.
Exactly. And because Bitcoin specifically, the spot ETFs are now so tied to U.S. liquidity, they got dragged down with the ship.
This brings up something that really bothered me looking at the charts yesterday. We always hear the narrative that Bitcoin is digital gold. It's supposed to be the hedge against this kind of government incompetence. But yesterday, Bitcoin tanked. And gold did something else.
Yeah, that's a painful chart for the maximalists. While Bitcoin was dumping alongside the Dow, gold hit an all-time high of $4,835 an ounce.
Why the divergence? If the world is scary, why aren't they buying the digital safe haven?
It's a reality check on where we are in the adoption cycle. In moments of acute sovereign stress, when governments are fighting, trade routes are closing, and bonds are breaking, institutional capital still flees to physical gold.
It's muscle memory.
It's centuries of muscle memory. Right now, Bitcoin acts like a risk asset, like a tech stock. Gold acts like the safe haven.
So until Bitcoin matures further, it's going to trade like the NASDAQ, not like a gold bar.
For now, yes. When liquidity dries up, risk assets get sold. Gold doesn't require liquidity in the same way. It's a store of value of last resort.
So we have the macro environment actively hostile to price. Japan is draining liquidity. The EU is threatening tariffs. Now let's look at the damage on the crypto side, because a lot of people got wiped out yesterday.
A systemic flush. We saw about $1.08 billion in liquidations across the crypto market in just 24 hours. And here is the key stat that tells the story. 93% of those were long positions.
Ouch. That means almost everyone was betting on the price going up.
Exactly. The market was incredibly frothy. Over 182,000 traders got wiped out. They were positioned for a Davos pump, expecting good news from the World Economic Forum. Instead, they got Macron's trade war speech. The market punishes that kind of crowded trade.
And we saw the retail panic in the ETFs too. I saw Fidelity had huge outflows.
Yes, the U.S. spot ETFs bled about $480 million yesterday. Fidelity's FDTC alone saw around $152 million in outflows. This is retail investors and financial advisors looking at the headlines, seeing the trade war talk, and hitting the sell button. They are fleeing volatility.
Okay, but here is where the story pivots. Because while retail is fleeing and screaming sell, someone else is stepping in with a bucket, a very, very large bucket. Let's talk about MicroStrategy.
The buy wall.
In the middle of this crash, on Tuesday, they announced a monster acquisition.
It's the definition of conviction. While everyone else was panicking, MicroStrategy deployed $2.1 billion to buy 22,300 Bitcoin.
$2.1 billion. That is not a small bet.
And look at the price point. The implied execution price was around $94,170 per coin. They were buying right as the market was starting to crumble. They absorbed about 20% of the selling pressure from that liquidation cascade.
I have to ask, though, and I think a lot of listeners wonder this, isn't there a risk here? If MicroStrategy owns that much of the supply, doesn't that centralize the market? If Sailor sneezes, the market catches a cold. Are they becoming a systemic risk?
It's a valid concern. Concentration is never ideal in a decentralized network. But you have to look at the mechanics of how they hold.
Yeah.
When an ETF buys that Bitcoin is rented,
Mm-hmm.
if the price drops, the retail investor sells and the ETF dumps the coins back onto the market. It amplifies the crash.
Right, like we saw with Fidelity yesterday.
Exactly. But when MicroStrategy buys, it's the Hotel California. It checks in, but it never leaves. They have no mandate to sell. They're capitalizing the company with Bitcoin. That supply is permanently removed from the trading float. So while it is centralization, it's also a massive stabilizer. They are fixing the floor.
So MicroStrategy is buying the volatility. They love it.
Yeah.
But there is another group of people who absolutely hate volatility retirees.
Yeah.
And usually, those two worlds don't mix. But you highlighted a piece of news about Delaware life insurance that you said was the most bullish part of the whole briefing.
I think this is the sleeper story of the year. It got buried by the price drop, but it's huge. Delaware Life launched the industry's first fixed index annuity, or FIA, with direct Bitcoin exposure.
Okay, fixed index annuity sounds incredibly boring. Why should our listeners care?
Because boring is exactly what Bitcoin needs to go to the next level. Think about the baby boomer generation. They hold the vast majority of the world's wealth, but they cannot afford to lose 10% of their portfolio on a Tuesday because Japan had an election.
Right, they need safety.
Exactly. This annuity product offers principal protection.
Wait, explain that. How do they get Bitcoin exposure with protection?
It's structured so that if Bitcoin goes up, they get a share of the gains. But if Bitcoin crashes to zero, they don't lose their initial investment. The insurance company takes on that risk and hedges it.
It sounds like magic.
Mm-hmm.
So the retiree gets the upside, but zero downside.
Correct. And to offer that, the insurance company Delaware Life has to buy the underlying asset or options to hedge their liability. This bridges the gap. It brings massive conservative retirement capital into Bitcoin in a way that is price agnostic.
So these insurance companies become forced buyers, essentially.
Yeah.
They aren't trading the chart, they're hedging a contract.
Exactly. It creates a permanent bid that doesn't panic over tariffs. This is the sticky money we have been waiting for.
I love that term, sticky money. So we have the corporate defense with MicroStrategy and the demographic defense with Delaware Life. Now, I want to shift gears to the technology itself, because while the price was tanking, the actual plumbing of the crypto industry got a massive upgrade on January 20th.
Yeah, the flight to quality isn't just happening in gold, it's happening in blockchain architecture.
Let's talk about this boundless and BitVM news. It sounds super technical, but why is this a hostile takeover?
Okay, so for years the narrative was Bitcoin is the pet rock that doesn't do anything, and Ethereum is the world computer where all the cool stuff happens.
Right. Bitcoin is slow, Ethereum is smart.
Boundless just flipped that. They announced they are using Bitcoin to settle zero-knowledge proofs for chains like Ethereum and Base using the BitVM framework.
Translate that for me.
Basically, they are doing the heavy computing on other chains, but they are using Bitcoin for the final security stamp. They are saying Ethereum is great for running apps, but when we need to be absolutely sure the money is safe, we are writing the receipt on Bitcoin.
So Bitcoin becomes the ultimate anchor.
Correct. It turns Bitcoin into a shared security anchor. It validates the thesis that Bitcoin doesn't need to change to be valuable. It just needs to be the most secure database in the world.
Which ties into the other piece of infrastructure news regarding the Noble Protocol. They are defecting from Cosmos.
This is brutal Darwinism in action. Noble is a major liquidity hub. It's where the USDC stablecoin lives in the Cosmos ecosystem.
Okay.
They announced they are leaving the Cosmos tech stack to build a standalone Layer 1 blockchain using the EVM, the Ethereum Virtual Machine Standard.
Why leave Cosmos? I thought the app chain thesis was the future.
It turns out liquidity is king. They are moving because they need access to the developers and the money that lives in the EVM world. It signals a massive consolidation. The market is saying, we don't want 50 different standards. We want EVM for execution and Bitcoin for collateral.
It's like the early internet. Eventually, everyone just agreed to use TCP/IP.
Exactly. The fragmentation is ending. The winners are being chosen.
And speaking of bridging worlds, Chainlink made a move that feels like it blurs the line between crypto and Wall Street even more. 245 U.S. equity streams.
This is huge for DeFi. Chainlink is now putting continuous pricing for stocks like Nvidia and Apple directly on chain.
So I can trade NVIDIA on a DeFi protocol.
You can create derivatives or hedges. Think about it. If you are a crypto native fund and you see the macro market puking like it did yesterday, usually you have to off-ramp to a bank to short the Nasdaq. That takes days now.
Yeah.
You can do it on chain instantly. It allows crypto natives to hedge macro risks without leaving the ecosystem.
It's closing the loop. Now, before we wrap up, we have to touch on the regulators.
Yeah.
Because usually when the market crashes, the regulators are the bad guys. But we have a new sheriff in town, right?
Mike Selig, the new CFTC chair, he announced his future-proof initiative on the 20th.
Future-proof. Sounds better than regulation by enforcement.
It's a complete pivot. He explicitly said he is ending the era of suing companies to create rules. He wants to create tailored registration categories for digital commodity platforms.
He mentioned prediction markets, too.
Yes, treating things like Polymarket as valid hedging tools rather than illegal gambling. This is the groundwork for onshoring the market. Right now, all the big derivatives volume is offshore. Selig wants to bring that volume back to the U.S. under a regulated framework.
And the asset managers are sniffing this out. Grayscale filed for a new ETF for Near protocol.
The Near Trust, yes. This is significant because Near isn't Bitcoin or Ether. It's a Tier 2 asset. Grayscale filing this S1 suggests they believe the SEC is finally ready to approve a wider range of tokens. They're moving down the risk curve, betting on a friendly regulatory environment.
So let's bring it all back home. We started with a sea of red and a lot of nausea.
We did.
We have Japan imploding the carry trade with higher rates. We have the EU brandishing a trade bazooka over Greenland. It's a mess.
It is. But look at the other side. You have MicroStrategy buying $2.1 billion. You have insurance companies building annuities for boomers. You have the CFTC rolling out the red carpet.
It really is a tale of two markets. The macro is fragile, but the structure is getting stronger.
The floor is rising, even if the ceiling is temporarily cracking.
So for the listeners staring at their screen, wondering what to do for the next 72 hours, what are the signals? What's on your monitor?
You have two screens to watch. First, the Japanese government bonds. Watch that 40-year yield. If it breaks 4.25%, the pain isn't over. We will see more forced selling.
And the second screen.
The EU. Watch specifically for the activation of the ACI. If the European Commission actually triggers the anti-coercion tool, not just flattens it, but triggers it, expect U.S. stocks to dump further, and Bitcoin will likely follow in the short term.
It's a volatile week, but I want to leave everyone with this thought. We are watching a wealth transfer in real time. Retail investors are selling because of a trade war headline. They are scared. But at the exact same moment, insurance companies and massive corporations are buying that dip to secure their balance sheets for the next decade.
That's the reality. When the dust settles on the Takaichi Shock, you have to ask yourself, who will hold the coins? The panic sellers or the principal-protected annuities?
That is the question. Stay safe out there, watch the yields, and thanks for listening to The Deep Dive.
Take